Welcome students. In this lecture we are going to be looking at the cost of capital. You can find this in your career textbook in chapter 7. There are various learning objectives we are going to cover in this lecture. In the first video we are going to look at the concept of the weighted average cost of capital. Then we are going to look at the various components making up the Wacc. In the second video, we are going to look at the relevance of calculating Wacc breakpoints and how are we going to determine this. We are also going to look at the delevering and relevering of betas and find out when is this appropriate. There are also various practical issues we are going to look at when estimating the cost of equity using the capital asset pricing model. So what do you understand by Wacc? So this is a topic you covered in your undergraduate studies, but here we are going to revise what you learned and also go deeper and cover new topics that you didn't cover in your undergraduate studies. What you should remember is that the job of the financial manager is to create wealth, and the financial manager will create wealth through effectively using the financial resources given to the company by the shareholder. The financial manager will take these resources and funds and will invest them in various business opportunities. These business opportunities will achieve a return at least equal to that required by the investors. So if we are looking at the example of a shareholder providing all of the funds to the company, the rate of return required by the shareholders is that company's cost of capital. Obviously, in practice, companies are not only funded by shareholders, they can also be funded through bank loans and debentures. So there can be various components making up the weighted average cost of capital. So it is assumed that a target capital structure exists for each and every company. What this means is that the management is basically accepting that there is an ideal proportion of debt and equity that exists in financing the company. So do you think companies actually disclose what their target weighted average cost of capital is? Generally, South African listed companies do not report their target Wacc. They will usually report that they will manage their capital structure in order to reduce their cost of capital, but they generally do not disclose what their Wacc is. However, there are some companies that do disclose their Wacc. For example, Truworths is a company that reports detailed information on the company's Wacc. So if we look at this diagram here, the weighted average cost of capital has been shown in grey by the grey line, and the black line shows the return on invested capital. From this diagram you can see that the weighted average cost of capital of Truworths has generally fallen over the period from about 19% to about 13%, except for the spike that you can see in 2008 and an increase in Wacc to 14% in 2014. So what you should gather from this diagram is that Truworths has been able to maintain a high return on invested capital over the same period, although if you look at the last 3 years, there's actually been a fall in the return on invested capital. But if we look at the overall difference between the return on invested capital and the weighted average cost of capital is positive. And it shows that management is obviously deriving a positive value for shareholders. If you want to look at more examples like this, in your textbook there's a nice example on Sasol. So what is the formula for the weighted average cost of capital? This formula should look familiar to you, as you would have used the same formula when you were in third year last year. So here you can see in this formula the various components that can make up your weighted average cost of capital. Obviously, every company would be different. We do expect that most companies are financed by debt and equity. So if we look at the formula, we need to understand a few principles to be able to apply the formula and calculate the WACC of a company. So when we are calculating the WACC, we need to make sure we are using marginal component costs. What this means is that we want information that is going to be relevant to the cost of new finance. If, for example, we are trying to determine the cost of debt for a company, we need to look at the interest cost of raising new debt and not at the cost of what past debt has cost us. So we are not going to use the average interest rate on bonds and loans that is reported in the company's financial statements. We need to use data that refers to the future when calculating the cost of equity and the cost of debt. We also need to make sure that we are using nominal rates after corporate tax. So when we are calculating our WACC, we need to use nominal rates. And the reason for this is that future cash flows are often stated in nominal terms, and therefore it makes sense that when we discount these cash flows, we need to use a nominal discount rate. Yes, in some situations we can take our real cash flows and discount them at the real required return, but often there are complications with this. When we calculate the WACC, we are basically looking at the permanent capital structure. So we will want to look at things like long-term debt. If we have a situation where a company is using an overdraft, this is usually classified in the statement of financial position as a current liability. However, consider this situation. If the company is using the bank overdraft every year for a period longer than 5 years, then in actual fact, even though it is treated as current in the financial statements, in reality it is no longer perceived to be a short-term debt. In actual fact, because it is ongoing, it should be considered to be long-term and included in the capital structure when we calculate the WACC. What weightings are we going to use? So when we are calculating our weightings to determine our WACC, it is actually useful to use the target capital structure if management expects the future weightings of debt and equity to change. If information is not provided in a question or a scenario that tells us what the target capital structure is, in that case you can assume that the current market values given to you will reflect the target structure. So now that we have looked at how to calculate the WACC and looked at the formula and also considered various principles, we need to actually understand what is the WACC going to be used for. So why is it so important for a company to calculate what the weighted average cost of capital is? One of the reasons why is that it needs to invest in capital projects. And in order to invest in capital projects, it needs to evaluate these capital projects first and ensure that the return generated from the capital project is going to be greater than the weighted average cost of capital. So if you think about capital budgeting, which you would have covered last year and are going to cover next, remember when we perform an NPV analysis, you are going to forecast the future cash flows from an investment project, and then you are going to discount those cash flows at the weighted average cost of capital. So it is important that a company knows what its WACC is, otherwise it may not be able to evaluate capital projects effectively. Another reason why we need to calculate the WACC is if we need to value a company and perform a valuation, particularly using the free cash flow valuation method. Again, here we will project future cash flows of the company, and we will need to discount those cash flows using the WACC if we are performing a free cash flow to the firm approach. If we want to calculate the economic value added by a company, then we will also need to determine the WACC, as the EVA is calculated by taking the net operating profit after tax less the WACC times the invested capital. So here we are basically assessing what shareholder value is being created, and we do that by looking at the return that the shareholder funds are generating less the cost of using that capital. Or remember, when we looked at the true worth slide, there we were comparing the return on invested capital, and we made sure that it was greater than the WACC. And this analysis can only really be done if the company knows what its WACC is. So if we look at certain state-owned enterprises like Eskom, here their aim is not really to generate shareholder value, and the prices they will be setting for their electricity will not be to make a huge profit, because that is not their motive. Their motive is to supply electricity. So they will need to find the point where their return on invested capital equals their WACC and set prices accordingly. So companies will also use the weighted average cost of capital when calculating the fair value of assets for corporate reporting purposes. So when we are trying to value financial assets, sometimes there's no liquid or orderly market to help us determine what a company's asset value is. So we can also use the WACC there. So when we calculate the WACC, obviously we need to know the various component costs making up the WACC. So usually a company will have a portion of debt, and here we will have to calculate what the cost of debt is. So what does debt refer to in this situation? Remember, we said we are looking at interest-bearing loans. And these are usually your loans that form part of your capital structure. So these can be divided into two main categories. There will be loans at a negotiated rate, like a bank loan, or the company could also have debentures in issue. So in the case of term loans, like bank loans, the required return will be the quoted rate that relates to the market rate currently being charged for similar loans. At this stage, we will ignore issue costs, but we will look at this a bit later on when we look at section 24J. If the company has debentures or bonds in issue, the cost of debt will be made up of the required return net of tax. So why are we looking at the interest rate net of tax? So interest is normally a deductible expense for taxation purposes. So SARS is in actual fact subsidizing the interest payment to the extent of the marginal tax rate of the company. So the real cost to the company is actually lower than the current interest rate because of the tax shield that SARS allows. So we must make sure when we are calculating the WACC that we are looking at the cost of debt after tax. If a company has bonds or debentures in issue, the cost of debt will be calculated by taking the required return net of tax. If we are trying to determine the cost of debt for redeemable bonds, we need to determine what the yield to maturity is, net of tax. So in this example, we have debentures that are not perpetuities. In other words, they have a redemption date. In this situation, the redemption date is in 5 years' time, and the par value is 100. The current price of the 10% debentures is 93 Rand and 80 cents. So we need to determine what is the interest rate implicit in this price. We need to compute the yield to maturity. So the yield to maturity is equivalent to the internal rate of return of the debentures cash flows. So if we calculate the internal rate of return, in other words the yield to maturity, by looking at the cash flows and putting this into our financial calculator, we'll see that the yield to maturity is 11.7%. Remember, this is before tax, and to calculate our cost of debt, we need this rate net of tax. So once we take the tax shield that the company will receive from SARS, our yield to maturity is 8.43%. So often there are issue costs involved when debentures are issued, and we will look at this in more detail when we look at section 24J later. So let's have a look at the class examples on the next slide. So in the class example, if you look at B, what is the firm's component cost of debt? So here the company has an issue 10% semi-annual coupon, non-cancellable bonds with 15 years remaining to maturity. They sell at a price of R1,081.44. The par value is R1,000. And if you look at the first point, the firm's tax rate is 40%. So we want to know what is the cost of debt for this scenario. So because the bonds are semi-annual coupon bonds, the rate given of 10% is an annual rate, but we need to calculate what is the rate per period. So the payment for one period, which is 6 months, is 5%. As these bonds sell at a price of R1,081, and this is greater than the future value of R1,000, these are said to be premium bonds. So if we want to calculate the yield to maturity, we can do that by inputting the various inputs into a financial calculator. So these bonds have 15 years to maturity, and because a period is 6 months, it means there are 30 periods. So you will input 30 into your financial calculator. The present value is the price of R1,081.44. The future value is R1,000. So if you input that into your financial calculator, you'll get the yield to maturity per period of 4.5%. So if we want to know the yield to maturity per annum, we will simply multiply that by 2. This is the nominal pre-tax rate, but we want to calculate the effective rate. So if we use the effective rate formula, we will get an effective rate of 9.2%. But remember, this effective rate is before tax. So we want to calculate what is the rate after tax, because that is what we need to do to determine our cost of debt. And remember, the tax rate was 40%. So if we take our effective rate of 9.2% net of tax, we will be left with 5.52%. And this is our cost of debt for this redeemable bond. So now that we have looked at bonds and debentures, let's have a look at preference shares. Preference shareholders will receive a dividend payment before any payment is made to ordinary shareholders. And preference shareholders have an expectation that dividends will be paid regularly. This is due to the fact that if a company fails to pay a preference dividend, it may not legally pay an ordinary dividend. There could also be voting rights that will be granted to preference shareholders if their dividend is in arrears. So if we look at our example here to calculate the cost of the preference shares, H Limited wishes to issue 12% perpetual preference shares with a par value of R1. Assume an issue price of R85.71 and no issue costs. What is the cost of the preference shares? So we can calculate the cost of preference shares by taking the dividend rate of 12% and dividing it by the price of the preference share, which is R85.71. So if we do that, we'll get a cost of the preference share of 14%. Because the cost of preference share is 14%, which is greater than the dividend rate of 12%, this means that the return received of 12% is actually less than the required return of 14%. The preference shares are obviously being issued at a discount. So when we looked at the cost of debt, we said that there was a tax shield available to the company on paying interest. When we have preference shares, there is no such tax shield on the dividends paid. However, it is possible that certain issue costs could have a tax shield. We'll look into this in more detail later on. So if we look at this example, which is similar to the previous example, except here there are issue costs which are 5 cents per share. So we want to know what is the cost of preference shares. So here again, the formula is similar to the previous formula, except we need to take into account the flotation costs. So we will calculate the cost of the preference share by taking the dividend rate of 12% and dividing it by the price of the preference share of 85.71 Rand net of the flotation costs. So the flotation costs need to be subtracted from the price per share. So this will give us a cost of preference shares of 14.87 Rand. And again, the return required is 14.87%. However, the return generated is 12%. If we compare the previous example with no flotation costs to this example using the same information except there are flotation costs here, we can see that the cost of the preference share is greater when there are issue costs than when there are no issue costs. So here, when we had issue costs of 5 cents per share, the cost of the preference share is 14.87 Rand, whereas when we looked at the example here with no issue costs, the cost of the preference share we got was 14%. Now what happens if we have a situation where we have redeemable preference shares? How will we determine the cost of these preference shares? And this is very similar to how we do it for redeemable debt. So let's have a look at an example. If we look at C1 and 2, they are asking us what is the firm's cost of preferred stock, and then is the firm's preferred stock more or less risky to investors than its debt. If you look at the third point, the current price of the firm's perpetual preferred stock is 115 Rand, with a par value of 100 Rand and a dividend rate of 9%. New perpetual preference shares could be sold to the public at this price, but Davis would incur flotation costs of 2.50 Rand per share. So how will we determine the cost of preference shares in this situation? So here, similar to the previous example, we will take the dividend rate and we will divide it by the price of the preference share net of flotation costs. In this example, the dividend rate is 9% and the price of the preference share is 115 Rand. And they have told us that there are flotation costs of 2.50 Rand per share. So if we input this into our formula, we get a cost of preference share being 8%. So depending on what the preference shares will be used for, there could be certain issue costs that SARS allows a tax shield on. So depending on what the finance is used for, SARS will allow a tax saving on the issue costs in certain situations. We'll have a look at this a bit later. If we compare the perpetual preference shares as a source of finance as compared to the redeemable debentures, we would want to compare the cost of the various sources. If we were to obtain the perpetual preference shares and use this as a source of finance, this would cost us 8%. Or we could issue debentures which require a return of 9.2%. So if we compare the cost of the preference share to the cost of the debenture, we will see that the cost of the preference share is less. It is only 8%, whereas the cost of the debenture is 9.2%. So preference shareholders require a return of 8%, whereas debenture holders require a return of 9.2%. The reason for the difference in the required return is that obviously that return is there to compensate for risk. So the preference shares are seen as less risky as compared to the debentures. If we want to know why the preference shares are perceived as less risky, we need to compare the terms of the preference shares to the terms of the debentures. So the preference shareholders get a return in the form of regular perpetual dividend payments, whereas the bondholders' return largely depends on the redemption of the principal amount, and this is at risk for 15 years. The debenture holders have to wait 15 years before the redemption of the debentures. So this makes the debentures more risky. Therefore, the debenture holders require a higher return to be compensated for this risk. This covers C1 and C2 in the class example. If we go to the next slide, we can have a look at C3. So in this part of the example, we are assuming that the firm's preference shares now have a mandatory redemption provision. And this specifies that the firm must redeem the issue in 5 years at a price of 110 Rand per share. So we want to know what is the firm's cost of preference shares in this situation. So if we want to calculate the cost of preference shares, we will do that by using our financial calculator. We can see that the payment is going to be 9 Rand, which is the preference dividend. It is for a period of 5 years, and it will be redeemed at 110 Rand after 5 years. The present value net of issue costs is 112 Rand and 50 cents. So if we calculate the cost of preference shares in this situation, it is 7.62%. And if we compare this scenario to the previous example, where there was no redemption of preference shares, the required return was higher where we had perpetual preference shares, meaning there was no redemption in place. But now, if we have redeemable preference shares, the risk is actually lower. And the reason for this is that the capital is recovered after 5 years, where the shares are redeemable. So now that we have had a look at preference shares, we need to move on to the cost of equity. So this is the cost of ordinary equity, and there are various methods that can be used to measure the cost of equity depending on the information given to us in the scenario. So the cost of equity is generally more difficult to determine. We have just looked at the cost of debt and cost of preference shares. Here, the cash flows were certain or known, whereas when we look at the cost of equity, because we are looking at dividends, it is more difficult to determine the cost of equity. If we look at the various formulas given to us, you'll see that it is often more difficult to determine the cost of equity. These cash flows are not certain. We do not know what the dividends will be in the future. So therefore, it is more difficult to determine the cost of equity. So when we calculate the cost of equity using the capital asset pricing model, this can be calculated by taking our risk-free rate plus our beta, multiplying the beta by the market risk premium. This is commonly used to determine the cost of equity for listed companies because there is information to calculate the cost of equity using this model. So what are the assumptions underlying the capital asset pricing model? One of the assumptions is that the investors hold diversified portfolios. So if we look at the formula, we can see that the formula multiplies the market risk premium by beta. What is beta measuring? So beta measures the level of systematic risk. So a company's beta measures the volatility of the risk in the market as compared to the risk in the company. So this model assumes that the only risk that is relevant is systematic risk. The rest of the risk, which is unsystematic risk, is assumed to be diversified away. If we are trying to determine the cost of equity for an unlisted company, it is possible to use the capital asset pricing model. Obviously, adjustments will need to be made for the differences that exist between the risk of the listed company and the risk of the unlisted company. Another way we can determine the cost of equity is by using the dividend discount model. How we calculate the cost of equity in this case is to determine the dividend that is going to be paid in 1 year's time, divided by the price of the share, plus the growth rate that is expected in dividends. This is sometimes used to value listed companies, however not as common as the capital asset pricing model, and the dividend discount model is not often used to value unlisted companies. So when we looked at the capital asset pricing model, we realized that there were various assumptions underlying the CAPM model. This is not always accepted by management and analysts. It is also sometimes difficult to obtain an accurate beta. Therefore, based on these assumptions and limitations, analysts sometimes determine the cost of equity by using the company's bond yield or interest rate and adding a risk premium to this. This risk premium is usually based on management's judgment or past experience. The risk premium that will be added usually falls in the range of 2% to 6%. The risk premium we are adding is not the same as the risk-free rate. One of the reasons why management likes using the cost of debt plus risk premium to determine the cost of equity is that there is a certain amount of confidence. The bond yield and interest rates are set by external forces to the firm. Even though the risk premium is subjective and depends on management's judgment, there is a certain amount of confidence that is given by using the bond yield and interest rate. This method is sometimes used to determine the cost of equity for listed companies, and it is also commonly used to determine the cost of equity of unlisted companies. So the bond yield plus risk premium is another way of calculating the cost of equity. So like I said previously, this is going to be based on the company's long-term yield to maturity or the company's long-term borrowing costs. A risk premium will need to be added to this though, to take into account that the cost of equity is more risky than the cost of debt. This risk premium is based on judgment. So if we look at the class example D, E, and F, so here we can see that the firm's ordinary shares are currently selling at 76 Rand per share. Its last dividend was 5 Rand, that is D0, and investors expect the dividend to grow at a constant 6% rate into the foreseeable future. The firm's beta is 1.25, the current yield on treasury bonds is 7%, and the market risk premium is estimated to be 5%. When using the bond yield plus risk premium approach, the managers assume a risk premium of 4 percentage points. We want to calculate the cost of retained earnings using the 3 different methods and the cost of new equity. So if we are looking at the cost of retained earnings, we are actually trying to determine what is the required rate of return on shareholders' funds currently invested. This is different to the cost of new equity. So do retained earnings have a cost? Yes, retained earnings do have a cost. There is an opportunity cost to ordinary shareholders. So the retained earnings could have been distributed as dividends. So its cost to the firm is the return shareholders could have earned from investing this amount in risky similar assets. So if we want to determine the cost of retained earnings using the capital asset pricing model, we can determine it by taking the information given to us in the question. So they told us that treasury bonds are trading at 7%. This is the risk-free rate. And they told us the beta is 1.25. The market risk premium is 5%. So if we input those into the capital asset pricing model, we'll get a cost of retained earnings of 13.25%. If we determine the cost of retained earnings using the dividend discount model, in our scenario, The last dividend, being D0, was 5 Rand, and this is going to grow by the growth rate given to us of 6%. This is the constant growth rate expected. And the price of these shares was 76 Rand. So if we input this into the formula, this will give us the cost of retained earnings being 12.97%. And if we want to calculate the cost of retained earnings using the bond yield plus risk premium method, so we need to take the pre-tax bond yield, which we calculated previously as being 9.2%. And to this bond yield, we are going to add a risk premium. This risk premium is based on management's judgment. However, we have been told in the question that 4% is appropriate to use as our risk premium when we calculate the bond yield approach. So if we use the bond yield plus risk premium approach, we can see that our cost of retained earnings is 13.2%. So if we look at all of the methods we use to determine the cost of retained earnings, we can determine an average cost of retained earnings, which is 13.14%. So now that we have looked at how to determine the cost of retained earnings, we can compare that to the cost of new equity. So if we use the dividend discount model to determine the cost of new equity, we will use the same information, except we need to take into account the flotation costs. We are told in the scenario in point number 5 that new ordinary shares would involve flotation costs of 10%. So if we calculate 10% of the price of the shares being 76 Rand, we'll see that each share has a flotation cost of 7 Rand and 60 cents. Our dividend today being D0 was 5 Rand, and we will grow this by the growth rate of 6%, divided by our P0, which was 76 Rand, less the flotation costs of 7 Rand and 60 cents. And then we are going to add the growth rate. This will give us the cost of new equity, and it is 13.75%. As you can see, when we are calculating the cost of new equity, this cost is going to be higher than if we were determining the cost of retained earnings. And the reason for this is that there are flotation costs involved when new equity is raised. So when we compare the cost of new equity, we got 13.75%. And if we compare the cost of new equity to the cost of retained earnings, the cost of retained earnings was 12.97%. The required return for new equity is higher than the required return for retained earnings. So if we want to determine the cost of equity for a listed firm, we said that the capital asset pricing model is the most commonly used method. But if we look at what makes up the capital asset pricing model, being the risk-free rate, the beta, and the market risk premium, there are certain factors that we need to take into account, as there can be difficulties determining these inputs into the formula. We also need to consider the assumptions underlying the capital asset pricing model. The most significant assumption is that there is an efficient market hypothesis. The capital asset pricing model assumes that there is a perfect capital market. So the efficient market hypothesis basically says that a company's share price reflects all the available information. And this may not be true. So there's a lot of discussion around the efficient market hypothesis that you can read more about on page 24 to 28 in chapter 4. Another pitfall of the capital asset pricing model is that it does not take transaction costs into account. Remember when we looked at determining the cost of new equity, and we determined this by using the dividend discount model. When we looked at the dividend discount model, we saw that we could take flotation costs into account, whereas the capital asset pricing model does not take into account any new issue costs. The dividend discount model is also sometimes used to determine the cost of equity for a listed firm. One of the advantages of the dividend discount model is that there are fewer variables to ascertain. If we are dealing with a listed company, there is publicly available information on the dividend and the price of the share, and this makes it quite easy to determine the cost of equity using the dividend discount model. Like we saw when we calculated the cost of new equity, we can take into account flotation costs. One of the assumptions underlying the dividend discount model is that the growth in dividends is going to be constant. In reality, this is not always true. So often it is very difficult for a company to determine a constant growth rate. One of the ways you calculated how to determine the growth rate in third year was to calculate the sustainable growth rate by taking your percentage return on assets after tax and multiplying this by your retention ratio. This will give us a sustainable growth rate, but how realistic is this growth rate? It is often necessary to look at forecasts to assess if our growth rate is actually going to be constant. If you want to look at the different ways to calculate the growth rate, you can have a look at Appendix 5.1 in Chapter 5. Because the dividend discount model takes the price of the share when determining the cost of equity, there can be certain pitfalls with this. The share price is an indication of what people are prepared to pay for the share. It is possible that the share price could be under or overvalued and may not reflect the true value of the share. So which method is best to use when we are trying to determine the cost of equity for unlisted companies? It is possible to determine the cost of equity using the capital asset pricing model for unlisted companies. One of the ways we can do this is to use a listed sector beta. If we take a listed beta and want to use this to determine the cost of equity for an unlisted company, we have to recognize that there will be differences in the capital structure for the listed company and the capital structure of the unlisted company. So we can actually delever the listed beta and then relever it to determine a beta that is more reflective of the capital structure of the unlisted company. We will have a look at delevering and relevering betas later on in the next video. When we adjust the beta of a listed company to determine the cost of equity for an unlisted company, we are taking into account the varying levels of systematic risk. This means we are taking into account the differences in financial leverage of the listed company and the unlisted company, but there could be other adjustments that need to be made. We may need to take into account additional risks, just like we did when we looked at valuations and we adjusted the PE multiple valuation method. We can make adjustments for the discount for lack of marketability. If the unlisted company we are trying to determine the cost of equity for is smaller than the listed company, we will make an adjustment to the beta for the difference in the size of the company. There could also be specific risks, just like we noted when we did valuations. If we want to use the dividend growth model to determine the cost of equity for an unlisted firm, we will usually find a similar listed firm and calculate the cost of equity using the dividend growth model using that listed sector's firm's information, such as the dividend and the price and the growth rate. Then we will need to make an adjustment for the above additional risks. This is not often used in practice. A more common approach to determine the cost of equity for unlisted companies is to use the bond yield plus risk premium approach. This is commonly used when trying to determine the cost of equity for an unlisted firm. It is not difficult to determine a market-based debt rate, as we will simply look at the variable rate of debt. However, the risk premium is more arbitrary and requires more judgment. Despite this, it is still a commonly used method when determining the cost of equity for an unlisted company. Now that we have looked at how to determine the various components making up the cost of equity, cost of preference shares, and cost of debt, we can combine these and determine the weighted average cost of capital. In the next lecture, we will be looking at more issues involving the weighted average cost of capital. Some of these issues are new things, like how to relever and delever beta. We will also be looking at how to determine the equity breakpoints. Thank you for watching.